At a recent conference, I asked a provocative question. Have equity markets become less efficient? I argued that the surge in retail investor trading, combined with the increasing dominance of passive investing, works against market efficiency. At one level, you would think that markets are much more efficient today. Transactions costs have plunged, fractional shares can now be traded, and settlement has sped up from 3 days to 1 day. However, these changes have greatly increased the participation of retail investors. New online trading platforms make trading easy and cheap. Retail investors can also acquire instant leverage by trading short-dated options. And these options dominate today's trading. But retail traders do not have access to the volume or the quality of data that institutional investors have. Indeed, this is why online brokers sell their order flow. Hedge funds would rather trade with retail investors than other hedge funds that might have better information. Another force is also at work: the rise of passive investing. In my new paper title, Passive Aggressive: The Risks of Passive Investing Dominance, Chris Brightman and I show that passive investing's share has spiked from about 10% 25 years ago to 53% today. But while low-fee index funds have an appeal, they have 4 key drawbacks. First, passive investing has no price discovery. Index funds ignore fundamentals and buy and sell solely based on capitalization. They do not care if the stock is over or undervalued. Second, correlations between stocks grow because flows lead to market orders, all stocks bought or sold. This decreases diversification and increases systemic risk. In a crisis, everything is dumped at the same time and correlations shoot up. Number 3, flows induce a momentum-type effect. As prices go up, more of the new flows are allocated to the stocks that have risen in value, potentially eclipsing fundamental value. Finally, with even slight over- or undervaluation, market cap weighting becomes a problem. Passive mechanically overweights overvalued stocks and underweights undervalued stocks, inducing a drag on performance. This problem is likely to worsen. Growth in passive investing relative to active investing shows no sign of slowing down. Extrapolating based on recent trends suggests that passive investing could represent 80% of the market in 10 years. Markets may become even less efficient in the future. Maybe think twice before buying that index fund for your pension or personal portfolio. For more on this, see my recent research paper, which is linked below.